I was kind of brought over to do, and currently sit on top of our investments for new acquisitions, along with helping on the capital raise side of things and asset management as well. Once the properties go into uh, operational side, that's where we kind of come in full gear, make sure that it's as passive as possible for our investors. And previous to kind of getting into this world, was an asset manager over with a bank, bridge lending facility. That's where I kind of got my experience there through COVID, especially as things kind of wound come to a halting stop, and had to maneuver kind of a $200 million portfolio with various borrowers, which was fun. So it's been a good ride so far. And as Abby mentioned, we're got a lot of different things going on, including residential and commercial. So we have a pretty wide range of experience on the team. So happy to be here today.
Awesome. And then Paul was able to join us. So Paul, do you want to introduce yourself here?
Yeah, hi everybody. I have known Jesse actually since 2010. I was a loan officer at the time, lending on fix and flip projects, and I started lending to Jesse. Was impressed by the job that him and his team did, mainly in San Diego, and I started lending to him on a consistent basis, and lent money to him up until I started working for him about a year ago. So it's been a great ride with him. Before that, I was as I say, I was a private money lender for over 30 years, and got into um, lending my own money on projects at that time in the mid 90s. Started it, really enjoyed it. It's a great alternative to either investing in the stock market, or if you want to buy property yourself. I did that. I didn't like it. I didn't like being a landlord. So this is a great alternative where I can be involved in real estate, have money in real estate, but not do the day-to-day operations of, working on properties and being a landlord, things I wasn't interested in doing. So currently I raise, I'm raising money for AJX, both in first position loans and gap loans as well. And very happy to be here, and thanks for joining.
Awesome. Thanks, Paul. So what we want to discuss today with you all is really just, why diversification is so important. So in a lot of our advertising or conversations, we kind of say we are a way to help diversify your portfolio and get you involved in real estate investing, but we don't go into the why very much. And so I just wanted to kind of take a step back, and this might be, kind of repeat information for some people, but if it helps anybody, that's really kind of the idea here. So on the left-hand side, we have what a traditional 60-40 portfolio typically looks like, where you have your bond allocation, you have your equity portfolio. And this is what a lot of people, kind of think about whenever they think about their investment portfolio. Or they might think, I have no idea what's going on. I have somebody that manages that. But they might not have exposure to a lot of other types of investments that can help with stability and just overall help with your portfolio risk, particularly when you're going through turbulent times in the stock market. So over on the right-hand side would be an example of that and some of the different ways that you can diversify within these different areas. So we're not going to have all of those, but when it comes to that real estate piece, that's really where AJX Capital comes in and can make this a really easy and enjoyable process for you. I always like to see some historical evidence. So if you're telling me it makes sense to diversify, well, why? Where's the data, and how has this happened before? So in the 2008 financial crisis, when the S&P dropped, real estate-backed investments and private credit didn't see that same drop as the traditional market did. So just giving you a real life example of why it makes sense to make sure you have a diversified portfolio. So when it comes to the different types of investments, at the top, we have real estate. And again, that's really where AJX sits between there and that second line, so private debt. We offer business loans and, not all the time, but when we're in these modes of expansion and growth, we open up the opportunity where you can lend to AJX Capital to our company. So as we're going through that growth, instead of going to a traditional lender, we open that up to investors. And with that comes higher fixed returns than you would see in a traditional real estate investment. And we're going to get through that or run through that in a moment. But between real estate, private debt, private equity, and commodities, a lot of these are the different types of alternative investments that when I talk to people on the phone and they book a call, a lot of times they're looking through these different options to see where they want to go in terms of diversifying their portfolio. So private debt has historically offered significantly higher returns than your typical bond yields and so forth. So that's why you would be interested, and people are kind of jumping at our business loan right now. So when it comes to investing in alternatives, really you want to kind of walk through this process of understanding what your investment goals are. So are you looking for growth? Are you looking for cash flow? Are you trying to minimize risk? All of the above, what are the real goals in this path to diversifying? Then you want to take a look at, your different, how your life is set up, retirement goals, all of that to assess how much do you need to kind of keep in cash and your overall risk tolerance. And then when I talk to people, they're usually getting to this explore stage. So they're trying to see, okay, what are the different opportunities out there? What makes the most sense for me? Like Paul said, people are like, real estate, great. And then they jump into getting an investment property, and before they know it, they have a second job that they really didn't want to sign up for, and they have no interest in being a landlord. And then that's a disaster. You don't have to do all that, right? So by getting with a company like AJX Capital, you're investing and you're reaping the rewards of a real estate project like that, but you're not doing the actual, unclogging of toilets and answering tenant calls that comes along with managing a rental property. Then there's the research. So conducting your due diligence and making sure, your sponsors or whoever you're working with has a track record. They have references. They've done this before. You don't want to be the guinea pig in the situation, working with a new sponsor. And then you invest. And usually that's done through an investment portal. And you have a team such as myself and Paul to help through that whole process. So again, that explore section is really where people start to come over to AJX Capital and we start to have these conversations. So when it comes to AJX Capital and our real estate and private debt, we have a few different offerings. We have first and second position liens on our fix and flips. So if you want to get involved with being a lender on our fix and flips, you can put forward an investment and in return, you get a fixed rate return. So it's 10% typically for our first position liens and 12% for our second position liens. You're tied to a property. So it's, secured by the property itself. It accrues over a year term and then is paid out at that year. And then from there, you can obviously choose to extend and continue to work with us from there. The third option there is our business loan. And so I kind of wanted to pull that out and just talk about that separately. It's something that a lot of our investors, a lot of my calls, people specifically are calling for that option given the higher rate of return. Let me just pop over here for a second. So with our business loan, we have three different tiers when it comes to this one. So the first tier starts at 15%. Then it goes to 17% and then 20%. So it depends on your investment size where you'd fall within that. We have monthly amortized payments. So a lot of people will say, I'm looking for something that's going to provide cash flow kind of throughout the life of the investment. I don't want to wait 5 years to see the money that comes through. So when I start to hear that type of thing and they're looking for higher, interest rate, this is typically where I'm going to be taking them in the conversation. So how this would work is you put forward your investment, and then at your 1 month, kind of anniversary of investing is when you would start to see those payments come through. So for a 50K investment, I just put an example here, you could see that the monthly payment would be about $4,500 a month. And then at the end of your term, you exit with your principal and your interest, and you're on your way. So other things, just to keep in mind with this is we have 100% repayment record. So for all of our investors over the lifetime of us doing this, we've repaid all of our investors 100%, both principal and interest. So just to help with some of the due diligence, and obviously you want to do more of that as we go, but that's an important feature that I would want to know as a potential investor here. Before I move on to an example of one of our fix and flips, does anybody have any questions on this, on the business loan or anything that I touched on so far?
I have a question, but just a minute, I'm running a calculation.
Is it on the amortized payment?
So you have in here 50,000 investment. Your monthly payment would be $4,500. That's just not, I think that's an annual payment at 15%.
Yeah, so you're getting your principal and interest back on a monthly basis, amortized, right, Jeremy?
Yeah,
Yeah.
it's amortized over 1 year.
So you're repaying back the principal and the interest.
Correct.
Got it. That makes sense. Okay.
Yeah.
And it's only a 1-year term.
You can do longer term, but it starts at 1 year.
Okay, that makes sense. Got it.
Awesome. All right, Paul, I'm going to throw it over to you to chat a little bit about this property in Florida.
Yeah, this is a fix and flip. We just got on the contract Monday, and it's closing the 15th. That'll be next Tuesday. We have a great group of people in the Tampa Bay area. The project manager and the agents. We have 3 or 4 people who look at every project that we're potentially going to do. I'm one of them. So when a project comes available, there's 3 or 4 of us that discuss it. First of all, we look at what we feel the after repair value will be. In this case, we came up with a after repair value of $460,000, which was confirmed also by a a hard money lender, who we do a lot of business with, who we gave this property to, and we wanted their opinion of what the value was after the work was done, and it came up to $460,000 with them as well. Anyways, we're buying this property for $295,000. The budget's $62,000, just cosmetic work. What we're doing is we're looking for people to invest in the first position loan, which is at 75% of the after repair value. So it's $330,000, a little bit over $330,000, and it will be the amount of the first position loan. You'll make 10%. It's a 1-year term. The average fix and flip in Tampa is 4.5 to 6 months. So traditionally, you would get your money back at that particular time. You get your principal back plus all your interest. The interest is deferred. You don't make we don't make monthly payments to the investors while the project is ongoing. You make all your principal, you get your principal back and all your interest when the property is sold. After, which is, as I say, on the average, it's 4.5 to 6 months. We're also looking for a gap loan. That's what we call them, gap loans, which are second position loans on these properties. I have traditionally done mostly gap loans. They pay 12%. And again, the interest is deferred. It's a 1-year term, but you get paid off your principal and all your interest when the property sells. And we expect to make, if it does sell for $460,000 and it does sell in that amount of time, We plan to make a little over $30,000 on this property. The average fix and flip in Tampa, $30,000 to $50,000 is our expected profit. In San Diego, the prices are higher. We're looking at 50 to 100,000 usually on the average profit on a fix and flip in the San Diego area.
Hey, Paul, do you have a microphone that you're using by any chance?
Yes.
I think that last part was a little bit muted. You were kind of fading out on my side. If you could repeat just the last part into the,
What
sorry.
was I talking? I forget.
You were kind of talking, I think, from what I could hear, just the overall, the ARV, a 75 to 80% is like typically our first loan
Yes.
size, and that's
Okay.
around 10%. Then I think you kind of started fading out when you mentioned the gap is what we
Yeah.
refer to
Sorry
as our
about that.
second.
Okay.
Okay.
Great. Yeah, the gap loans are traditionally I've done more gap loans than first position loans because of my experience with AJX and Jesse, and also my confidence in them, who they have working for them, the project manager, the general contractors we have. I feel very confident that we will sell the property for what we feel the value will be, the after repair value, or close to it. And therefore I do, mainly gap loans, which pay 12%. And like first position loans, the interest is deferred until the loan pays off. So you don't get any payments as an investor until the loan pays off, and then you get all your principal back plus all your interest. And again, this property, if anyone's interested in discussing it, give me a call or send me an email, and we can discuss this project or any other projects that we're looking for, either first position loans or gap loans.
Yeah, so this is just one example, but we have a lot of different properties that we are working with investors on and matching them with what makes the most sense for them. So some people like being in at the first position at the 10%. Some people prefer that second position that Paul was saying at the elevated 12%. So it's really just about, booking a call with us. We can go through the different projects that we have available and see what might make the most sense for you.
So I had a question. Is it 12% annual interest? Meaning if it takes 4 months, it's 4 months over 12, or is it?
No. Yeah,
12?
you make 1% a month, basically.
Thank you.
Yeah.
Good clarification question. There was one other question that came in from Dr. Robert. I'll just read it out loud really quick. About a possible war between the U.S. and Israel and Iran. So basically, macroeconomic impact and how that might affect the real estate market here in the States. So just overall, I think macro fear and how that might kind of affect us in the different markets that we're in. So without being able to exactly pinpoint what might happen there, obviously there's interest rates that fluctuate a ton. There's supply chain impacts. I think with at least our business model, the way we're able to get in and out of properties and have construction done as rapidly as we do because we're not adding square footage or ADUs, accessory dwelling units. We're really going in there and doing mostly cosmetic works. We like to say we're all about consistency, hitting singles and doubles. Occasionally, if the market continues in our direction, we'll hit a home run every now and again, but we go into each property expecting to be out of it within 3 to 6 months is our typical sweet spot average. So there, the velocity helps us to see what's going on in the economy, and if stuff is hitting the fan, we can kind of pause altogether new purchases and focus on finishing out what we do have in our pipeline and under rehab. So I'd say speed is the biggest thing on our side because we also purchase what we consider these entry pocket homes. As you can see this in Tarpon Springs, we're positioning to sell this to an end retail buyer at $460,000. My dad lives in this neighborhood actually. It's a good price point. I'm familiar with it, and I live in San Diego. I know the markets, and Paul does as well. He's been here for decades. Each pocket of San Diego is a little bit different, but in terms of the average of each sub neighborhood, we try to stay really within the price range that's going to create a lot of demand, regardless of I think what's going on. So, kind of a long-winded answer, but wanted to address it because it's a good point that leads into our overall business plan and mitigating the downside risk.
Yeah. And I'd also say just the length of time that AJX has been doing this type of work. So being able to, see our track record through different market conditions and various things that are happening that are outside of our control. All right.
Yeah, I'm sorry to interrupt, Abby, but I just wanted to mention, I think that's why I like to invest in gap loans and first position loans with fix and flips because they're quick. Your money stays liquid. So if the market does change quickly, we should be in and out of these projects within a matter of months. And then you can decide if you want to stay in cash or if you want to continue to invest with us. So.
Great.
Good point. All right. This looks like it might be my slide.
It is.
All right. What else? So I think a few years back, the owners, being that their bread and butter was fix and flips, their investors had some other requests within, hey, I've heard if we invest on the equity side of larger projects, multifamily, as a limited partner, we could realize some depreciation as a pass through, even if we're an LP or limited partner. And that's kind of what emerged about 5, 6 years ago to expand some of the investment offerings into multifamily. We do anything from as small as 4 units all the way up to 200 plus units in a single asset. This one is on the smaller side. It's a current opportunity we have over in St. Petersburg, outside of a flood zone. It's, as you can see, it's built on kind of the cinder blocks format over there, and we're projecting a cash flow play here. Not a ton of renovations need to be done to these 11 units. The only unit that needs to be renovated is actually being delivered to us upon closing, fully brand new. So that's kind of, we're stepping into some value day one there. And the structure that we have here, every offering is a little bit different. We try to keep it similar with what's called a preferred rate of return, meaning the investors' dollars get paid first before the general partner participate in the profit. And once the 7% pref rate is paid to our LPs, or limited partner, then we split the cash flow profit 70% to our investors and 30% to us as the owner operators or general partners. Trying to go, I'm kind of going into the weeds a little bit. So anyone that is unfamiliar with this space, it's just a way for us to purchase somewhat small opportunities like this, all the way up to larger opportunities by pulling together funds, putting some of our own funds into the deal. And these hold periods are typically projected from a 3 to 7 year hold time frame. Again, why we like this is there's some cash flow along the way. I think what we have modeled here right now is a conservative kind of a 5% per year actual cash distribution or dividend paid. So on $100,000 investment, that's $5,000 a year. We aim to kind of start paying that out towards the end of year one. And then anything that's not paid on the preferred rate is accrued. So again, it compiles every year until we catch up that preferred rate. Usually it's upon a refinance or a sale, and the same kind of waterfall distribution. So I might be going a little bit too much into the weeds there. I know there's different kind of folks who have participated with us in the past on this call, and just wanted to explain a little bit of the nuance. There's some people that are interested. Happy to answer any questions now, or our team can answer any questions. You'll see our contact information there too. But again, the reasons we like it, we're projecting a total return once we go and sell the asset 14 to 16% or higher, what we call an IRR, internal rate of return, to our investors after any and all profit shares and any and all fees. That's why it's a little bit more attractive. We're kind of targeting that true IRR for this type of deal. And our closing timeline, the last thing here, it's within a few weeks. We got a mini extension with the seller as they're finishing out some construction on that unit that I mentioned. So if you're interested, there's a little bit of time to get in touch with our team and learn more.
Thank you. Does anyone have any questions? What you
Yes. Is this available where we can get it on recording? My husband got hung up at work.
Yes, I forgot to hit record right at the beginning, but right after our intros, all the rest of it is recorded.
You just got the good
How do I-
stuff in there.
How do I get access to it?
I'll send it to you. It'll come out in an email after this with
Yep,
a
thank you.
Yep.
This is Kevin. I assume that you get K1s and some of the depreciations passed through on that as well, correct?
Yes, with that deal right there, you would get a K1
Yeah.
statement.
Yeah. All right. Thank you so much.
You're welcome. All right, short and sweet. Pretty much it. This is our contact info. If you want to scan a QR code, you can go right to our website as well, or just take a picture of this. We'd love to chat with you. No pressure, just even, if you just are looking for some more information or want to ask some questions we weren't able to get to today. We love just talking to you and hearing what's going on and your thoughts and everything. So don't hesitate to reach out. And yeah, just thanks for showing up and being with us here today. We appreciate it.
Thank you.
Thanks.
Thanks so much, guys. Enjoy your evenings.
Thank you all.
Bye-bye.
Bye-bye.
Take care.
Thanks.
Thank you.